Hello and welcome to Martyn Lucas Investor. My name is Sensei and we are here for the morning forecast show. We're here every single morning and today we have a few top stories. Markets are bracing for jobs report. We're bringing you that live right now. We also have a story on XRP nearly at breaking $2.30, bring to you as well. But this is the morning forecast show live every single trading morning where we look at the thundery markets if they're down on the day, what sort of forecast we're getting, if it's going to be a sideways action moving day where not much happens, a bit of accumulation, and the market decides what to do, or is it going to be a pump day when everyone makes money? So let's see what sort of day it is going to be today. Thank you everyone for tuning in to today's show. What we're going to start off with is by just quickly having a look at XRP. As I said, downwards trend broken, failed to break $2.30, came back in for the retest of the downwards trend. Now here we go again. $2.30 is on the cusp of breaking out. On my X this week, I did put, "Are you feels like it's going to be a good week for crypto? Is everyone ready?" So far, so true. Do follow me on X. The link is in the description. I'll give it to you in the live chat as well. It did feel like it was going to be a good week, and it does seem like that's playing out right now. There is the link for my X. So $2.30. Once that breaks, and I think it probably will at this point, as long as we don't get any bigger corrections in the broader markets, I do think $2.60 can happen very, very fast. That will be an additional 14% move up for XRP. All we need to do is break $2.30, break the previous areas that we failed to break, $2.33, $2.34, hold $2.30, and then we're off to $2.62 in my opinion. Again, nothing I say is financial advice. This is my thoughts, my opinions only. So let's see what happens. It does look like we're going in. We tried last time, we took out the liquidity. Now we're going again. Let's see if we do manage to break out. In about under an hour's time, we're going to have the unemployment data. That could throw everything off into spirals. If it's too high, then we might get rate cuts. The market might like it. If it's too high, then the Fed has going to have to react, and then the market won't like that. If it's too low, then people will say, well, there's not going to be any rate cuts. They won't like it. If it's too low, then they go, the Fed's not going to reduce rates. So there's all sorts of it's going to be very volatile. I wouldn't suggest trading it because there's so many things. Let me check. If it's too high, then we might get rate cuts. The market might like it. If it's too high, then the market. Refresh. It is not my. I don't think it's a problem on my end. Refresh if audio issue. If there's an audio issue, please do refresh because I don't think that's something on my end. It sometimes happens with YouTube. Let me check. Nothing on my end. So do refresh if you're having an audio issue. So yeah, the rate cuts, we're going to be covering them. I'm going to put shall I do this? Let me see if I can do this. Let me put a no, it's not PPI. Let me change that. Bear with me one moment. I'll put this on screen. Edit text. Here we go. Jobs. Data in. There shouldn't be an audio issue. Please do refresh the stream. And it's going to be going over to Martyn's show in about 40 minutes time. There we go. Okay, so I'm just going to put that on screen so we don't forget what's coming up shortly. I will be ending the stream a little bit earlier than normal and we'll be going over to Martyn's stream. So that unemployment data, the jobs data, everything that's coming out in the next hour, we will have that data in an hour. It's going to throw shockwaves throughout the market because there's so many different possibilities. As I just mentioned, is there going to be rate cuts? Well, if it's too high, then there will be. If it's slightly higher, there might be. If it's lower, then there might not be. If it's too low, then the market will be even more bearish because they'll say, well, everything's looking good, there won't be any rate cuts. So all sorts of possibilities. Traders, serious traders around the world playing with billions of dollars will be trading this. I wouldn't suggest the normal retail investor goes in and trades. So let's see what happens in today's jobs data. That could definitely send XRP breaking through $2.30. And right now it is trying to do that ahead of the jobs report. We've also got Litecoin at 4%, ADA, something we mentioned yesterday, around 54 cents. It was the chart of the day in the newsletter. It wasn't randomly the chart of the day, it was at a good zone. And that's up since we put that post out over 11% in 2 days. That's what you get on the S&P 500 in a year. So congratulations to ADA holders, or the ones that bought ADA yesterday. You've got Dogecoin up 2.7%. Everything is ready with double bottoms. There's a lot of double bottoms around the crypto space. Even Bitcoin regaining 106,000, back 109,000, hit 110,000 this morning, and it's only 2% away from all-time highs. This can heat up quickly. This can start moving fast now. Then it's 115,000, then it's 130,000, and it can all happen in the next 38 minutes when we go over to Martyn's stream, because um, if the markets takes the jobs report as a good news, however they price it in, it's quite hard to say, but however they price it in and they're taking it as a good news, maybe it's what's expected or slightly higher than what was expected, and people start pricing in rate cuts, then um, then we can see Bitcoin head up another 2% all-time highs, and then it can heat up. Bitcoin goes to its next levels, 115,000, 130,000. That's when you get XRP potentially breaking $2.62, heading to $3, $3.50. So things can start heating up fast now, and it's been happening slowly. People haven't really been keeping up with the fact that Bitcoin is literally, from the highs of today, it was less than 2% away from all-time highs. I mean, that's nothing for Bitcoin. 2% is nothing. So there we go. That's the story on the unemployment data coming out. It is in today's newsletter. So if you go to the newsletter today, I'll give you the link for the newsletter. You've got a lot of stories in today's newsletter every single trading morning, so do not expect it tomorrow. We might do something special, but tomorrow is not a trading day. There is the link for the newsletter. I'm going to pin it as well. I've also got a let me pin this. That's the link for the newsletter. I've also got a poll running in the chat right now, which says, is your portfolio at an all-time high? And I'll tell you why I'm asking that question, because it's an important question to ask. It's in the newsletter about why it might not be. So is your portfolio at an all-time high? 35% of you say yes, stocks mainly. 12% of you say no, stocks mainly. Yes, crypto mainly was 24% of you. Oh, there we go. Poor man to rich man. I love it. I apologize that I didn't have the alerts on. I was filming a video yesterday, but we will give you full appreciation. Here we go. Thank you for everything you do, Sensei. For us, Sensei. Poor man to rich man. Thank you for all the support you give us. We wouldn't be here without the super chats. We wouldn't be here without the support. So thank you, everyone, for your support, and poor man to rich man especially. Thank you for supporting with a super chat. So no, crypto mainly is 33%. So it looks like most people aren't at all-time highs, and if you're holding stocks, you're more likely to be at all-time highs. That seems to be the votes right now. Continue voting in that poll, and I'll tell you why I'm asking that question, because I've got some important information for you regarding that. So the US unemployment rate ticked up to 4.2% in June, with job growth expected to slow sharply to just 85%. A jump up to 4.3% would keep the Fed in comfort zone. So the money move of the day. I'm going to talk to you about the all-time high. So ignore the first part for now. We'll come back to it in more detail. We've got the market snapshot there. So the US jobs report, labor market softening ahead of key Fed policy decision. The June unemployment report becomes a critical test, and for that reason I'm going to have to, I don't know why that's why I've got the months wrong there. Let me just check what I've done here. Let me just edit this. Just going to remove that for now. I'll edit that later. Let me just update that. Update now. There we go. Oh, just trying to check something. Making sure okay, that's fine. So the June unemployment report becomes a critical test for whether, and this is happening in the next 45 minutes. The June unemployment report becomes a critical test for whether the Fed Reserve will accelerate rate cuts after the labour market showed signs of cooling in recent months. The current unemployment rate stands at 4.2%, but economists are watching for potential rise to 4.3% amidst slowing hiring demand. Wall Street consensus expects non-farm payrolls to increase by 110 to 115,000 jobs in June, down from 139,000 in May, while unemployment rate is forecasted to tick up to 4.3% from 4.2%. So that is what we're expecting, 4.3%. If it's a little more, then the market might take that as a positive because they might say, well, rate cuts will come if it's at 4.4%. If it's at 4.5 or 4.6%, then you can expect the market not to like that because it will be too high and it will show that the Fed were too late to cut rates and it will be more of a reaction. So keep that in mind. Wall Street consensus, we've done that bit. Some economists predict even a weaker job growth, with Goldman Sachs forecasting just 85,000 jobs added and RSM estimating 100,000. Average hourly earnings are expected to moderate to 0.3% month over month from 0.4% in May. A rise to 4.3% unemployment, and this is what we're expecting, would keep the economy well within the Fed's comfort zone, as officials project unemployment to reach 4.5% by year end. The critical recession indicator, the SARM rule, wouldn't trigger until unemployment hits 4.6% on a 3-month average basis. We're not close to that at all. However, any reading above 4.3% could accelerate Fed rates cut expectation, particularly if combined with weak job growth below 100,000. Two things we're watching. Remember, we can't predict it. We don't know how the markets react. We're not economists here. We're just dubiously speculating. But what I can speculate is 4.3% is what we expect, so the market probably won't react that much. Maybe it'll go up a bit because it's no big surprise. 4.4% is when the market might even rally, even though it's a worse than expected number. Why would I say that? Well, in my opinion, if it's 4.4%, then the Fed might expect to cut. We might expect the Feds to accelerate their rate cuts before it gets close to that 4.5% mark. So the market actually might rally even if it's higher than expected. That's just a guess on my end. We don't know if that will happen, but I'm expecting if it's 4.4, the market might initially take it badly, but then they might rally because they might say, well, rate cuts are coming now. If it's any more than that, if we're looking at potentially 4 point, let me just check this over here. If it's any more than that, for example, I'm just trying to see this. Why is that not? I apologize. Oh, here we go. Yeah, if it's any more than 4.5, let's say it's 4.6%, then that's when it will be bad. And that's why my thumbnail, it says 4.4% potentially good, 4.6% bad, because 4.6% is when, if you have that for 3 months in a row, you get the SARM rule coming into place. People will start calling for a recession, and then the Fed was too late. So if you get anything like 4.5, 4.6%, expect a sell off. 4.3, 4.4. Potentially it will go up a little bit lower. It might be fine as well, but if it's too low, if it's at 4%, then people will say, well, there's no reason for the Fed to cut rates. So that's all the things that can be going on in people's minds and the traders around the world. So the Fed currently views the natural rate of unemployment at around 4.2% to 4.3%, meaning readings above this level signal labour market slack that could justify monetary easing. And that's why a 4.4% rate unemployment rate is not even that bad, because that still means that they are looking to cut rates. The jobs report will arrive as investors price in approximately 75 basis points of rate cuts this year, with the first cut potentially coming in September. The market's not pricing in a rate cut this month. Um, I know Martyn said either last month or this month. That's his prediction, and the market's prediction is not this month. So today's data will really change based on um, um, today's data will change that expectation. If you go onto the Fed Watch tool, I can bring it up for you guys. This is literally what they use, the Fed Watch tool, the CME Fed Watch tool. Here it is. You can very clearly see um, this meeting in 30th of July. The chance of a rate cut are around 25%. The market is pricing in 75% chance um, of the rate staying the same. This will change in the next hour. Get ready for that. The markets are expecting that by September, there is basically a 71% chance that when we're in September, the 17th, there will be a rate cut. Whether that's this month or next month, it's not saying in September there's going to be a rate cut. It's saying by that meeting and during that day, there the target the interest rates will be at 400 to 425 basis points. Um, and there is no expectation for a rate cut at the moment for this month, so that might change. A weaker than expected report could push Fed towards more aggressive easing, especially given Chair Powell's recent acknowledgement that the central bank is attentive to risks on both sides of its dual mandate. So there we go. That's what's happening in the next 27 minutes. That's what's going to rock the market. So thank you everyone for tuning in. I'm going to tell you a different story as well. We've got quite a few stories that I want to share with you. Make sure you've hit the like button if you're here with us. Subscribe if you haven't done so already as well. Get ready for some volatility. So Sensei sent me just broke $2.30. Good morning, all. Good morning. I'm gonna skip through some comments. If it's cutting out, just refresh your stream. It should be fine. People taking profits should just let it hit what it's going to hit. Says poor man to rich man. Yeah. Let me just look at members' questions. As much as I'd love to see XRP blow the top of the market, I think right now it's just being suppressed to build structure they need before it really starts pushing higher. Um, Eddie Bucket, I wouldn't look into it that much. I don't think anyone's really suppressing the price that much. Yes, there could be some manipulation here and there, but if the FOMO comes in, if Bitcoin's at 150,000 and people are buying altcoins, so retail will come in and they will buy it up, and you can see it push higher. Um, Mark Saxby's here. Good morning, Sensei and family. Thank you, Mark Saxby, for tuning in. It's going to be a good day, says Jesse. Did they pause the ETF indefinitely? No, they didn't, not indefinitely. XRP is testing $2.30 again. Yes, that will be quite a level to break. Seems like it. It's back for review. Yeah, it's not indefinitely, but um, it does seem like they have paused that ETF for some reason after they approved it. I don't quite understand. I need to look into that further. Weird question, but if I transfer 1,500 XRP to my wife, is that considered a sale, and do I have to pay taxes? Is that considered a sale? Um, no, not in the UK. Again, I'm not giving you financial advice, but in the UK, I don't know where you're from, Jesse. In the UK, transferring between wife and husband, you don't have to pay capital gains most of the time. Again, go check the rules yourself, but that's my understanding. In the UK, anyway. Hi, Sensei. Good morning. Love the show as always. If you could only hold three coins for the next 5 years, which ones? Mine would be XRP, HBAR, and XCD. Um, if I could only hold five, goodness, it'll definitely be XRP. Probably Flare. 5 years, goodness. Maybe Bitcoin, even though I don't really hold Bitcoin. Sensei sent me. Let's go look at the family. XRP is at $2.30 now. Let's have a look. Okay, we need to get on to our next story. I am going to be ending the show in about about 20 minutes time, 15-20 minutes time. So I want to get on to the next story as well. XRP right now is at $2.30. Let's see if we get a break. It can happen any moment now. So the next big story I want to bring to you guys, there is a lot in the newsletter today which we won't be able to cover. One is the Ripple applies for the US banking license, follows Circle lead in a stable coin regulation push. Linked to implodes. That's the one that you could have bought private companies shares. Looks like a few issues there, and people were buying Ripple shares there. We've got Gilt's bounce as Starmer locks in Reeves. So that story about Rachel Reeves leaving and the bond market tumbling. Well, Starmer came on late last night and told us that that's not happening and it was personal issues. So we've got updates on that. We've also got a story there. But the one I want to cover right now is, and this is the reason we have the poll, a deeper dive. SPY is at all-time highs, so why isn't your portfolio? Chart of the day, VU USA versus VUSA. That's the UK version of, that's the UK tracker, the Vanguard S&P 500 versus VU. So let me do a story on this and we'll make it into a video. So to do that, I'm going to remove this. Okay, let me go full screen. Here we go. Let me make sure I'm centered. Okay. Breaking news on Martyn Lucas Investor. We are looking at why is your portfolio not at an all-time high when the S&P 500 is, and I'll give you the data around that. So thank you for tuning in, and this is going to be a special video. Please do watch until the end. There's basically three reasons why. One is you're probably not in the US. So you can see a chart here. This is from our newsletter. Every single day we do a newsletter. Today's main story, the deeper dive section, we had 5 main stories of the day. Plus this is about this story that I'm bringing to you as a video. You can see this is a chart of the Vanguard S&P 500. That's VUSA. That's the UK version of VU. And you can see that is up 22% since January of 2024. But then in pink here, you have VU, the US tracker of the S&P 500, and that is up around 32%, so about 10% more. And I'm going to tell you why you need to be careful of this. So this chart shows a clear divergence since January of 2025. Vanguard's S&P 500 ETF in Great British Pounds, ticker symbol VUSA, is up 22%, while its USD counterpart VU has gained 32%, a full 10% difference on the same underlying index. Everyone's saying the S&P 500's is at all-time highs, but maybe not for you. So more recently, since January of this year, VUSA is actually down 3%, while VU is up 5.5%, once again reflecting a near 10% performance gap driven purely by currency effects, currency impact, the hidden tax on international SPY returns. So a roughly 10% decline in the US dollar during 2025 has created a disconnect between headline S&P 500 performance and the actual returns seen by global investors. Although the index is up 5% year to date in USD terms, those gains have been largely offset or reversed. We're actually down in the UK 3% for investors abroad, so not just the UK, Europe, other countries as well, abroad due to currency headwinds. For those holding unhedged positions, especially in countries like the UK, the weakening dollar has significantly eroded real returns. UK investors bear the brunt. British investors, for instance, have seen the pound surge to $1.37 from around $1.22 at the start of the year, a nearly 13.7% appreciation. That strength has erased any S&P 500 upside in Great British pound terms. The dollar index has also dropped to the 97 mark, making it the worst half-year dollar performance in over 50 years. That is a big piece of data for you guys. Worst first half dollar performance of 50 years. People in the US holding the S&P 500 are at all-time highs. People holding it in the UK are actually down on the year, and pretty much nowhere near all-time highs. So since UK investors must convert their pounds to USD to buy US stocks like ETFs like SPY or VUSA, they have taken a direct hit. A stronger local currency makes your US denomination holdings worth less when converted back, a drag many overlooked when assessing portfolio returns. You need to be understanding currency risk. And I'm not telling you to do something now, it's probably too late, but you need to take this into account in the future. Currency risk is certainly a risk, and if you're not hedging your position, then there is an issue. In the UK, you go onto Trading 212 or wherever and you buy US stocks, your money in pounds gets converted to dollars and then you buy it. And then you have that whole currency risk as well. And a lot of people have been basically seeing stocks up 10%, but in real terms, their FX returns are down 10%. Why? Because the currency risk there, and you're not even up on an asset that's actually up. So take that into account. So the growing hedge response, as a result, institutional investors are adapting. 10% of Russell Investments European clients have increased their hedge ratios on their equity portfolios. One large fund moved from 50 to 75% hedge exposure. Meanwhile, SPDR ETFs now offer cost-efficient currency hedge share classes, often adding 0 to 5 basis points in costs. For international investors, ignoring FX risk can be more costly than market volatility, especially in low return years. Another reason you might not be at all-time highs is you're probably choosing individual stocks. The concentration reality check. Another reason your portfolio may be lagging the index is you're likely not even holding the index. The S&P 500 record-breaking concentration means that gains are being driven by a handful of stocks while most others lag. The Magnificent Seven outsized impact. By early 2025, the top 10 companies made up by nearly 40% of the S&P 500, up from 26% during the dot-com bubble peak. Apple 6.9%, Microsoft 6%, Nvidia 6% alone nearly comprise 20%. This means that the vast majority of the market is not participating in the rally. While the cap-weighted index is up 5%, the equal-weighted S&P 500 is flat to negative. So you've got the S&P 500 version where it just tracks all 500 in an equal weight, and that's actually down on the year. So you can see that you're probably down because most of the other stocks are actually down, whereas the Magnificent Seven are up and they're making up most of the gain. So if you're holding the Magnificent Seven, you might actually be up more than the S&P 500. If you're holding the other parts of the S&P 500, you're probably down as well because of the way it works and how individual stocks are underperforming the Magnificent Seven. So over the 5 years, the gap is even wider, 110% total return for cap weighted versus 84% for equal weight. You can see that the weighted S&P 500 outperforms the equal weighted S&P 500. And that just gives you an idea of what individual stocks holding means versus holding the S&P 500. So the breadth problem. Under the surface, most stocks are bleeding. The 9 smallest S&P 500 companies are down an average of 20% in 2025, with a median drop of 19.3%. Even mid-sized names outside the tech elite are mostly flat. While mega caps absorb all the passive flows, individual stock pickers are swimming against the tide. Historically, this level of concentration has signaled poor forward returns. During the last two extremes, 1980s and 2000, the top 10 names subsequently underperformed the broader market, and only Microsoft outperformed long term after a 19-year drought. So again, that is about individual stocks. That might be another reason you're down. So even for the people in the US, the dollar devaluation, you might say, well, I'm at all-time highs. It's great for me. Well, don't forget your currency is getting devalued. So the dollar devaluation, the erosion of US purchasing power, even if you're in the US, sitting on a portfolio highs, the dollar decline still matters. The DXY's multi-year low is quietly eroding real returns and buying powers. both domestically and abroad. Inflation and real returns. Inflation is stable but persistent at 2.35%. A 5% portfolio gain only nets a real return of 2.65. Add margin on top of that. If you're paying 4% for margin, a normal year of the S&P 500 completely eroded. So keep that in mind. And as the dollar weakens, imports and globally priced commodities become more expensive, especially gold, which has spiked to $3,300 an ounce. And JP Morgan is forecasting that to go to $3,675 an ounce. Don't forget, gold is not just going up for the sake of gold going up. It's going up because inflation is persistent. You've got dollar being devalued, and you've got geopolitical concerns. So that's why I always said gold is a vital part of people's portfolios. Again, that's not financial advice, that's just what my thoughts are. That means that the dollar has lost nearly 25% of its value relative to gold, a hard asset barometer for long-term wealth retention. Gold is the standard of purchasing power. If you want to keep your purchasing power, gold is the standard that's been used for thousands of years. So, global purchasing power erosion. This also affects American consumers abroad. Foreign travel, global real estate, and international investing are now more expensive. The weaker dollar functions as a hidden tax on global lifestyle and investment optionality, particularly for retirees and high net worth individuals with global ambitions. The Fed policy and structural headwinds. The Fed expected 175 basis point cuts in rate cuts over the next year are central for currency decline. Lower rates reduce capital inflows and suppress demand for US debt and equities. Reuters FX survey shows nearly 90% of strategists expect the continued dollar selling. The era of USD strength might be fading. So this is something that analysts are saying rate cuts are coming. That's going to bring the dollar down, and 90% of strategists are saying that the dollar is going to continue selling off. So keep that in mind. So the conclusion. The S&P 500 is rising, but the story under the hood is more complex. For international investors, currency depreciation offsets market gains. For stock pickers, index concentration hides the reality that most stocks are flat or down. And for US investors, the dollar's devaluation quietly erodes real purchasing power. Investors must recalibrate, hedge selectively, diversify across asset classes and geographies, and understand that real returns, not nominal figures, are what truly matters. I thought this was a very important story to bring to you all. And while this is being made and this is all from the newsletter, so the link for the newsletter is in the description below. It is the first link in the description, so please do go ahead and sign up to the newsletter. Not only do you get these deeper dive stories, you also get the market snapshot. You get the 5 things you need to know, what's happening every single day. It's a daily newsletter with charts, with top stories, and everything you need to know if you're an investor in the market. So please do check that out as well. We also have a poll running in this is made during a live video. A poll is running. Is your portfolio at an all-time high? And I've got 4 options. One is yes, and you're in stocks mainly, that's 31%. No, stocks mainly 9%. Yes, crypto mainly 24%. No, crypto mainly 36%. So we've got about 50% of our live viewers, and that's about 171 votes so far, that are at all-time highs, and 50% that aren't at all-time highs. More of the people that are at all-time highs are holding stocks, and probably the S&P 500 index. But please do remember, if you aren't in the US and you are seeing that everyone's saying the S&P 500 is all-time highs and you're not, it's because the dollar's being devalued, and that is why you're not at all-time highs. That FX toll is pretty big, especially with the dollar down and expected to continue going down. The other reason might be is you're picking individual cryptos and stocks, which most of the time underperform the S&P 500. If you're picking stocks, you've just seen in that report that most of the other parts of the S&P 500 are down quite significantly or flat, and the Magnificent Seven are propping up that index. So keep that all in mind, and going forward, you can make sure you are hedged against currency risk. For example, that is the poll right there, and that's the results. Thank you for tuning into this video. Until next time, take care of yourselves and each other. There'll be 2 videos up here. So what we're going to do now is go over to Martyn. He will be covering the, let me see, the obviously the Martyn's going live in 7 minutes for the payroll data live. We've got the jobs report coming out, the unemployment data coming out, and we're going to be showing you that very, very shortly. So stay with us. Let me do this, and let me do that. So have I missed any questions? What did you all think about that report? Have you kept that into consideration? My UK and European investors, have you seen the FX impact on your portfolios when you invest in the S&P 500 and US stocks? Let me know. Is that hurting you guys? Good morning as always. Let's have another look at XRP. Currently sat still at $2.30. Still at $2.30. I told you Ripple will become a bank. Wink, yes, we've always said it. Kind of hard, isn't it? Good afternoon, XRP is not going to really move. I'm going to just go to my members' comments. If you want to become a member, here is the membership link. Position for the moonshot and prepared for the way down. Will we break $2.33? That is what we're expecting if we get the volatility in the jobs data, which is coming out very shortly. We're going to go over to Martyn's stream in a few minutes' time. If you actually understood macro and FX, you would have been loading up on emerging markets a month ago. The setup was screaming buy when everyone was distracted. Is there a basket stock that covers precious metals? Probably, but there's only a few precious metals anyway that you really want to be worried about. Gold, silver, maybe platinum, um, maybe a bit of copper, but gold is really what you want to be invested in. To become a member, hello, one-dimensional, no macro view, no global strategy. The whole world is outside the S&P. I agree with having a global portfolio. I like having probably the FTSE all world, the top caps, the top 10 companies in the world, top 100 companies, having gold, silver, um, emerging markets, currency diversification, gold, silver, crypto, all that sort of stuff. I believe in a fully diversified portfolio. So let's get ready for Martyn's show. Is there anything else I wanted to share with you before we go over very shortly? I don't think so. I might come again. Remember, tomorrow is a bank holiday in the US, so there will be no. I imagine there won't be a stream for me and Martyn tomorrow. If there's any big news, we will be live. So do stay with us, because tomorrow we might come live. I might come live with a show to cover some news stories that we haven't managed to cover this week and put them out as videos. Oh, here we go. We've got a comment. The FX is costing me thousands, but still at an all-time high. Luckily, Andrew Phillips. There we go. Someone getting hurt by the FX fees, but I'm glad that you're still at all-time highs. Good. Congratulations to you, Andrew. You will understand what I meant by that story. So I'm going to end the video and we're going to go over to Martyn. I apologize that I'm ending early today. We want to get the build up with Martyn, and I have to end this one early. That is already put in there. Martyn will be live in just under 3 minutes. So thank you. Come on, let's have a big rally. Yes, we can. We're going to be covering the jobs data. That can be make or break. That's when the volatility will come. XRP is on the brink of breaking $2.30. Let's see if that happens in the next few minutes. Thank you everyone for tuning in. No show tomorrow. There might be a show tomorrow. Keep an eye out. You never know. It's a bank holiday. We might come live, we might not. Until next time, take care of yourselves and each other. Go to Martyn's stream. The link is over here. Go and say Sensei sent me. Sensei sent me. I want everyone to go and say Sensei sent me. Let me give you the link for Martyn's show. I'm going to put it into your comment section. 50-50 show. Says just fluffy. Here we go. There is the link. That's where we're going now for the jobs data. It's going to get volatile. Stay with us. Until next time, take care of yourselves and each other. Bye bye.